You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome back. If you've been keeping an eye on the digital asset space lately, well, it's been quite a roller coaster.
Yeah.
Just wild.
Absolutely dizzying is the word.
Yeah, and you've probably seen those big, scary headlines about all the volatility. But here, we try to dig a bit deeper, look under the hood at what's actually going on.
Mm-hmm.
We're looking at, massive stress tests on the underlying tech, these quiet, but really fundamental steps forward in regulation, and this whole new wave of AI-driven protocols starting to emerge.
It really feels like the space is grappling with two completely different realities at the same time.
Totally. It's almost bipolar, right? Like, look at the contrast.
Yeah.
One minute you hear about Paxos accidentally minting, $300 trillion worth of their stablecoin because of a bug.
Which they burned immediately, thankfully. Imagine that.
Right. Crisis averted. But then, the very next day, you've got Erebor Bank getting preliminary approval for a national charter from the OCC, a crypto bank.
Exactly. It's chaos and convergence happening side by side.
So that's really what we want to unpack today, these three big threads. The market chaos testing everything, the steady march of institutions and rules, and then this future tech stuff with AI and machine payments.
Yeah, it's the perfect picture of Web3's two sides.
Yeah.
You've got the speculative casino, and then you've got the factory quietly building the foundations.
Okay, let's dive into the chaos first. That massive market drop on October 10th, it seemed to come out of nowhere.
Well, the trigger was pretty clear. President Trump's surprise announcement about a 100% tariff on China.
Ah, right. And market reaction was just instantaneous, vicious. We saw the largest liquidation event ever in crypto.
Yep. $16.7 billion in long positions liquidated, just gone. Wiped out over $19 billion in market value in hours.
That number itself is staggering, $19 billion.
Yeah.
But I heard some talk that the real number might be even higher.
Yeah, that's a fascinating and kind of scary side note. Data firms like CoinGlass and also the CEO of Hyperliquid, they suggested that the centralized exchanges, the CEXs, might be seriously undercounting these liquidations.
How so?
Well, they argue the actual number could be, get this, up to 100 times higher. The theory is that CEX reporting often only catches, say, one liquidation per second, even if hundreds are happening in that same second during a panic.
Whoa. So the hidden leverage getting flushed out could be absolutely massive.
Exactly. Mind-boggling scale, potentially.
And you can't talk about this without mentioning the insider whale, right? Wallet 0B317.
Oh, yeah, that story is wild. This trader apparently made nearly $200 million because they shorted the market just 30 minutes before the tariff news hit the wires.
30 minutes. That's suspicious timing, to say the least.
Suspicious is one word for it. Perfectly timed, certainly. And now, apparently, this same trader has just opened up a new $163 million short on Bitcoin with 10x leverage. So they're still playing the game.
It just shows how much high-stakes speculation and, maybe information asymmetry is still driving things.
For sure. But the fallout from this whole event gave us a really valuable, if painful, test of the different financial systems, centralized versus decentralized.
And how did the centralized exchanges hold up? Not great, from what I gather.
Not great is an understatement. Binance, for instance, ended up paying out $283 million to users because their systems just couldn't handle the pressure.
What exactly went wrong there?
They had lags, display errors, but the really critical failure was in their margin engine. It started mispricing key wrapped assets, things like WBETH and BNSOL.
Okay, wait. Let's slow down there. For listeners maybe not deep in crypto trading, what does it mean for a wrapped asset to be mispriced by the margin engine?
Sure. So a wrapped asset, like wrapped Bitcoin or wrapped Ether, is basically just a token that represents the real Bitcoin or Ether, but on a different blockchain. Its value should always track the original asset one-to-one.
Got it.
What happened at Binance was, during the panic, their system started valuing the wrapped token based on its temporary crashing price on Binance itself, instead of the actual value of the underlying Bitcoin or Ether held securely somewhere else.
So it triggered liquidations based on a fake, temporary price dip on their own exchange.
Exactly. People got liquidated even if their underlying position was perfectly fine based on the real asset price. It's a huge flaw stemming from that kind of closed, opaque system.
Which makes the contrast with DeFi pretty stark, doesn't it? How did the decentralized platforms fare?
They held up remarkably well. Hyperliquid, for example, reported zero downtime throughout the whole thing.
Zero downtime. Impressive.
And lending protocols like Alav and Morpho, they processed record amounts of liquidations. We're talking $180 million for Alav, $100 million for Morpho, without accumulating any bad debt. None.
Wow.
That's really the key takeaway here, I think. This wasn't just a market crash, it was a live stress test. And it showed that these open, transparent DeFi liquidity pools are just structurally more robust under extreme pressure than the black box CEX margin systems. They worked exactly as they were designed to.
We should also probably clarify the whole DPEG situation that happened, right, with Athena's USD stablecoin.
Yeah, good point. The term DPEG gets thrown around a lot, sometimes inaccurately. In USD's case, it actually held its dollar peg perfectly fine on decentralized exchanges like Curve.
But it crashed on Binance.
Right. It dropped below 70 cents on Binance.
Oh.
But that wasn't the stablecoin itself failing. It was a failure of liquidity specifically on Binance. A venue issue, not an issuer collapse. We need to be careful with that distinction.
Okay, so local liquidity drying up versus the whole stablecoin mechanism breaking down. Different things.
Precisely. Most of these recent DPEGs have been localized venue problems, not the underlying asset or collateral failing.
And just to round out this segment on chaos and tech, even amidst all this big money drama, the smaller, more sophisticated hacks kept going, didn't they? Like on Solana.
Oh yeah, the attackers don't sleep. On Solana, apparently 93% of all the value extracted through front-running now comes from these things called wide sandwich attacks.
Wide sandwich attacks. Sounds unpleasant.
It is for the victims. Basically, these attacks spread across multiple blocks or slots, making them harder for standard detection tools to spot. They've netted attackers something like 500,000 SOL over the last year. It just shows security is a constant battle no matter what the market's doing.
Okay, so the CEX infrastructure definitely showed some cracks under that pressure. But while all that speculative chaos was unfolding, there was this other narrative happening almost in parallel, right? The builders just kept building, focusing on more permanent structures.
Exactly. Let's shift gears completely. We've seen the volatility test. Now let's look at the quieter but maybe more significant story of regulatory progress and institutional adoption.
Right, the foundational signal versus the market noise.
Yeah.
Where do we start? That bank charter news seems huge.
It really is. Erebor Bank getting preliminary conditional national bank status from the OCC. That's a major step. And the head of the OCC, Jonathan Gould, specifically said this shows they aren't putting up blanket barriers for banks wanting to work with digital assets.
That's massive for building trust with the big institutions, obviously. But hang on, doesn't this kind of go against the whole original idea of Web3? I mean, Nick Szabo, the guy who basically invented smart contracts, famously said, trusted third parties are security holes. If we're now relying on the OCC and national bank charters to make this stuff legitimate, are we actually building Web3, or are we just building, like TradFi 2.0, a faster, shinier version of the old system?
That is the core tension right now, isn't it? It's a philosophical battle. And it looks like, for now at least, the market is choosing the path of convenience, regulatory clarity, and massive scale over absolute, uncompromising trustlessness, which, let's be honest, is often hard to achieve politically.
So Erebor isn't the only one going this route.
Not at all. Bridge, another player, also filed for a national trust bank charter. There's this growing belief, especially around stablecoins, that they have to operate under full regulatory oversight to become a truly foundational part of the financial system. They need that stamp of approval for widespread adoption.
And we're seeing similar moves globally too, right? Not just in the U.S.
Absolutely. Singapore Central Bank, MAS, launched their Bloom initiative that's designed to settle transactions using tokenized versions of bank liabilities. Super interesting.
And back in the U.S., even regulators like SEC Commissioner Hester Peirce are talking about reform. She's suggested crypto could actually help update old rules like the Bank Secrecy Act, AML, KYC, making them work better for peer-to-peer transfers.
It all points towards institutions getting ready for serious scale. You look at analyst projections, like from Bernstein, they're predicting the supply of USDC, a major stablecoin, could almost triple by 2027, from around $76 billion now to maybe $220 billion.
$220 billion.
That kind of growth forecast is really driven by this perceived move towards regulatory clarity and focusing on the compliant players.
Okay, this next piece is where things get really, really interesting for me. Integrating traditional risk assessment with DeFi S&P Global. The S&P partnering with Chainlink.
Yes. This is huge. S&P Global is going to start publishing its Stablecoin Stability Assessments. Basically, they're risk ratings for stablecoins directly on-chain, starting on the base network.
Directly on-chain. What does that actually mean for, like, a DeFi protocol?
It means a smart contract can automatically check S&P's real-time risk rating for a stablecoin before allowing a transaction or using it as collateral. No human needed. It's automated compliance using trusted external data.
That's a massive step for making DeFi feel safer for big players, I imagine.
Monumental. A smart contract doesn't need to just trust the stablecoin issuer anymore. It can ping S&P's rating via Chainlink and verify the risk level itself.
But wait, if the data comes from S&P via Chainlink,
Mm-hmm.
aren't we just shifting the trust? Now we have to trust Chainlink to deliver the data correctly and trust S&P to make the right assessment. Where does the trustlessness actually end up?
That's a great point. We're not eliminating trust entirely. We're moving where the trust is placed. You're trusting the decentralized Oracle network, Chainlink, to be reliable, and you're trusting S&P's reputation as an assessor. The benefit is that once that data is on-chain, it's transparent and can't be tampered with. It's probably a pragmatic compromise, necessary to get institutions comfortable enough to participate at scale.
Makes sense. And this isn't just theoretical infrastructure building, right? There's actual business happening. Coinbase Business, launching that platform for smaller companies.
Yeah, directly competing with traditional fintechs, offering payments, asset management, even yield on USDC holdings 4.1% APY. That's aiming right at the heart of business banking.
And you got to love the Steak and Shake story. The Bitcoin Steak Burger.
Yeah, with the little Bitcoin logo stamped on the bun. Apparently, after they started taking Bitcoin payments, they saw double-digit growth in same-store sales for 2 quarters straight.
Seriously.
Yep, and they partly credited the buzz and support from the Bitcoin community. It sounds quirky, but that's actual, tangible business growth happening because of crypto adoption, real economic activity.
Okay, so we've got the institutions and regulators laying down some tracks, trying to make the existing stuff more robust and compliant. Now let's look ahead. What's coming next? This idea of an AI agent economy sounds pretty sci-fi.
It does, but it's starting to take shape. We're talking about agentic commerce, basically. Software programs, AI agents, acting autonomously on your behalf.
Like what? Give me an example.
Imagine an AI that can find the cheapest flight for you, negotiate extras, book it, and pay for it, all without you lifting a finger. That's the vision. These agents transact with each other.
Okay, cool concept. But how do they pay each other? If millions of tiny transactions are happening between bots, wouldn't gas fees on Ethereum just make that impossible?
Exactly. That's the massive hurdle. Transaction costs. If every little AI interaction costs gas, that just doesn't work. Circle is tackling this head on. They're integrating their gateway system with something called the BY 402 protocol.
And what's the magic trick there? How do they get around the fees?
They're introducing a batching feature. Essentially, it bundles up potentially hundreds of thousands of these tiny machine-to-machine payments off-chain. It processes them all together and then settles the net result in one single transaction on the blockchain.
So you only pay gas once for potentially thousands of little payments.
Precisely. It effectively eliminates the per-transaction gas cost for the individual agent interactions that could finally make this kind of high-frequency AI commerce actually viable.
And there are even standards being developed for these agents to find and trust each other.
Yeah, like ERC 8004. You can think of it almost like LinkedIn for AI bots. It's a standard where an agent is represented as an NFT, and that NFT lists its capabilities, how to interact with it, its reputation, etc. So agents can discover and verify each other trustlessly.
Interesting. Okay, shifting gears slightly within this next-gen theme, privacy. That's always been a huge challenge in crypto, right? Especially with regulators cracking down on things like Tornado Cash.
Definitely. And we've learned some hard lessons. The early approaches focused on total anonymity, like CoinJoin or Tornado Cash. But those ran into major political and regulatory headwinds. They just didn't scale socially or legally.
So what's the new approach?
The trend now is towards selective disclosure, giving users privacy from, say, competitors or the public internet, but still allowing for compliance and auditability when needed. Scroll's new feature, Cloak, is a great example.
Cloak? What does it do? And it uses ZK proofs, right? Can you break that down simply?
Yeah, it uses zero-knowledge proofs. Okay, the simple version. Think of a ZK proof as a way to prove something is true without revealing the underlying data that makes it true.
Okay.
Like, you could prove, yes, I've paid my taxes without showing your entire bank statement. Or, in Scroll's case, a business could prove these funds are compliant and didn't come from a sanctioned source without revealing all their sensitive transaction history to the public or competitors.
But they can reveal it to a regulator if asked.
Exactly. It provides an audit trail for regulators when necessary, but keeps the raw data private otherwise. It's trying to find that balance compliance proofs instead of total, untraceable anonymity. That seems to be the path forward for broader adoption.
And big players are jumping on this layer 2 privacy-focused train, too. I saw Alipay launch something.
Yeah, Alipay, which is part of Ant Group, massive company, launched an Ethereum Layer 2 called Jove. Its main focus is tokenizing real-world assets, things like supply chain invoices or bonds, and bringing them into DeFi. It's explicitly designed to act as a bridge that meets regulatory requirements.
So connecting the real world to DeFi, but with compliance built in from the start.
That's the idea. And finally, we can't forget the base layer itself is still evolving. Ethereum's got some big upgrades happening. ENSV2 for the Ethereum name service.
Right, the .f names.
Yeah.
What's changing there?
The big change is moving from one giant flat registry to hierarchical ones. It basically gives owners of a name like yourcompany.eth direct control to create and manage subnames like payments.yourcompany.eth, much more flexible, and it has native support for layer 2s built in.
More organized, more scalable.
Yep. And speaking of scaling, there's a serious proposal, EIP 7935, to increase Ethereum's mainnet gas limit, basically its transaction capacity, by 33%, from 45 million gas up to 60 million. That's a significant throughput boost planned ahead of the next big upgrade, Fusaka. So the core devs are definitely still pushing the limits. #outro.
Wow. Okay, so we've covered a lot of ground. From that insider whale-making bank on perfectly timed shorts, all the way to S&P Global, putting stablecoin ratings on the blockchain. It really is a space of extremes, isn't it?
It absolutely is. And I think if there's one thing to take away from all this, it's that you're really seeing two completely separate stories playing out at the same time.
Right.
On one hand, you've got the headlines dominated by the crazy speculation, the leverage, the volatility, the whale games.
The casino, basically.
Mm-hmm.
But running right alongside that, often much quieter, is this deliberate foundational work. Banks getting charters, compliance tools being built, AI protocols getting ready for prime time, the core tech scaling up, the factory.
And understanding that both of these things are happening simultaneously, the wild speculation and the serious building, that's kind of key to figuring out where this whole Web3 thing is actually going, isn't it?
I think it's essential and brings us back to that challenge you raised earlier, the philosophical one, about trust.
Yeah, the Nick Szabobo quote, "Trusted third parties are security holes."
Exactly. As we see these systems increasingly integrating with trusted names like S&P, or relying on regulated banks, or using services from companies like Cloudflare for verification, the big question remains, can this ecosystem hold on to that original core value of minimizing trust, of true decentralization?
Or does it just become a more efficient, maybe slightly more transparent version of the financial system we already have? That's the multi-trillion-dollar question, isn't it? And I think the way you figure out the answer is by watching where the smartest people are focusing their energy. Are they building tools for real economic activity, for actual commerce, for efficiency gains, creating real GDP? Or are they just building fancier ways to offer 50x leverage? That tells you a lot about the long-term direction.
A really crucial distinction to keep in mind, and definitely something for you, the listener, to think about as you watch this case evolve. Thanks so much for joining us for this look into the wild, contradictory, but fascinating world of Web3.
Thanks for having me. It's never boring.
Never a dull moment. We'll catch you next time.
Spoken Tech for your ears.